Welcome to our deep dive on the IRS Rule of 55. In this video, we will explain how to legally access your employer retirement plan funds before age 59.5 without paying the 10% early withdrawal penalty, and how to avoid a common tax withholding trap. We will begin with what the rule is, then move through eligibility, the 59.5 myth, tax withholding mechanics, and practical steps to use it correctly. After that, we will compare alternative strategies and walk through examples. Finally, we will test your knowledge with a quick quiz and end with key takeaways and a brief disclaimer. Here is today's roadmap. First, we define the Rule of 55. Next, we confirm eligibility with a concise checklist. Then, we bust the 59.5 myth. After that, we expose the tax withholding trap and show you how to prevent or fix it. We will also provide a practical, step-by-step process, example numbers, and a comparison to related strategies like 72T and governmental 457B. Finally, we include a short quiz, key takeaways, and a disclaimer. The Rule of 55 is an IRS exception to the 10% early withdrawal penalty for qualified plans like 401ks and 403B. If you separate from service with your employer in or after the calendar year you turn 55, distributions from that specific employer's plan can avoid the 10% penalty. Importantly, this rule does not apply to IRAs. It is tied to the plan of the employer you leave. Therefore, you generally want to keep money in that employer's plan if you intend to use the Rule of 55. Additionally, some categories of public safety workers may qualify as early as age 50. The income tax still applies to distributions. The rule only removes the 10% penalty. To determine eligibility, start by confirming that you separated from service with the employer. Next, verify that your separation occurred in or after the calendar year in which you turn 55. Then, ensure that the funds are still in that employer's plan, such as a 401k, 403b, or TSP. If the money has been rolled to an IRA, the Rule of 55 will not apply, and you will need a different strategy. Special rules can apply to governmental 457B plans and to certain public safety employees who may be eligible at age 50. Finally, be sure that the distribution is coded correctly by the plan administrator to reflect the separation after age 55 exception. This sequence diagram illustrates the operational flow. First, the participant requests a distribution under the Rule of 55 from the plan administrators. Then, the plan reports the distribution to the IRS via Form 1099-R, ideally with Code 2 to indicate an exception applies. However, sometimes the plan issues Code 1, which suggests no known exception. Meanwhile, the plan withholds 20% federal tax on most non-periodic distributions by default. In some cases, administrators mistakenly add an extra 10% withholding as if the early penalty applied. At tax filing, the taxpayer reconciles the year's taxes. If the 1099-R shows Code 1, the taxpayer should file Form 5329 to claim the separation after 55 exception and seek a refund of any extra 10% withheld, assuming all requirements are met. Let's clear up a common misconception. You do not have to maintain the account until age 59.5 to preserve your Rule of 55 eligibility. Once you have met the conditions and begun penalty-free distributions from that specific employer plan, additional withdrawals from that plan can continue to qualify for the exception. However, if you roll the funds to an IRA, the Rule of 55 does not apply to those IRA withdrawals. Therefore, avoid rolling to an IRA before taking the distributions you need under this rule if you intend to rely on it. Here is a practical workflow. First, confirm your separation date and whether it occurs in the calendar year you turn 55 or later. Next, retain funds in that employer's plan. If useful, consolidate old 401ks into the current plan before you separate. Then, contact your HR department or plan administrator and explicitly state that you are requesting a distribution under the separation after 55 exception. After that, ask them to code the distribution so the 1099-R reflects the exception, commonly Code 2. Expect default 20% federal withholding on most non-periodic distributions, and plan your cash needs accordingly. If you prefer installments, ask whether payments projected for 10 years or more have different withholding. Later, when you receive the 1099-R, check the code. If it is Code 1, Be prepared to file Form 5329 to claim the exception. Finally, research your state's rules and maintain thorough documentation. Let's address the tax trap. For most one-time or non-periodic distributions from employer plans, there is a mandatory 20% federal income tax withholding. Some plan administrators, however, mistakenly add an extra 10% withholding as if an early distribution penalty applied. To avoid this, request proper distribution coding based on the separation after 55 exception and confirm it in writing. If the 1099-R still shows Code 1 or the plan withheld the extra 10%, you can file Form 5329 with your tax return to claim the exception and seek a refund of the unnecessary withholding. Keep in mind that although the penalty is waived, the distribution is still taxable as ordinary income unless other exclusions apply. Here is a simple illustration. Suppose you withdraw $40,000. Under correct coding, the plan withholds $8,000 at 20%. If your ultimate federal tax rate is 12%, your actual tax would be $4,800, leading to a refund of approximately $3,200. In a mistaken extra 10% scenario, total withholding becomes $12,000. If your actual tax is still $4,800, your refund could be about $7,200, reflecting the recovery of the unnecessary extra 10%, assuming you properly claim the exception. Let's compare. The Rule of 55 allows penalty-free access from the employer plan if you separate in or after the calendar year you turn 55. It offers flexibility in amounts and timing, but requires you to keep funds in that employer's plan. Taxes still apply. In contrast, 72T, substantially equal periodic payments can work for IRAs but require a rigid payment schedule for a prescribed period, and breaking the schedule can trigger retroactive penalties. Governmental 457B plans usually have no 10% early distribution penalty regardless of age, though income tax still applies. The best choice depends on your access needs, plan features, fees, and investment options. This timeline highlights key ages. First, some public safety employees may have an exception at age 50. Next, age 55 marks the Rule of 55 threshold when separation in or after that calendar year enables penalty-free plan withdrawals. Then, at age 59.5, the general 10% penalty ends for most retirement accounts. Finally, required minimum distributions begin for many individuals at age 73 under current law, though that age can change if the law changes. Understanding these milestones helps you plan access and tax timing. Quiz time. Question. If you separate from your employer in March of the same calendar year you turn 55 in November, can you use the Rule of 55 from that employer's plan? Option A. Yes, because separation occurred in the calendar year you turn 55. Option B. No, because you were not yet 55 on the separation date. Option C. Only if you roll funds to an IRA first. Option D. Only if you wait until age 59.5 to withdraw. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is A. The Rule of 55 is based on the calendar year, not the specific day you reach the birthday. Therefore, separating in any month of the year in which you turn 55 qualifies you for the exception from that employer's plan, assuming all other conditions are met. Second question. Do you have to keep a balance in the plan until age 59.5 to keep using the Rule of 55? Option A. Yes, keep funds until 59.5. Option B. No, once eligible, subsequent withdrawals from that plan can be penalty-free. Option C. Only if you move the funds to an IRA. Option D. Only for monthly installments. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is B. You are not required to maintain the plan until age 59.5 to preserve the exception. Once you qualify and begin penalty-free distributions from that employer's plan, subsequent withdrawals from that plan remain eligible. Do note that rolling the funds to an IRA removes the Rule of 55 protection for those moved assets. Before we wrap up, a quick but important disclaimer. This video is for educational purposes only and does not constitute tax, legal, or financial advice. Rules can change, and your personal situation may differ. You should consult a qualified tax professional or financial advisor before acting on anything we have discussed. Additionally, state income taxes and penalties can differ from federal rules. Always review your plan documents, confirm coding with your plan administrator, and keep thorough records. Let's recap the essentials. Separate in or after the calendar year you turn 55 to qualify. Keep your money in that employer's plan if you plan to use the rule. Expect a default 20% federal withholding on many non-periodic distributions, and try to avoid any mistaken extra 10% by ensuring proper coding. If the 1099-R shows code 1, file Form 5329 to claim the exception. Remember, this exception waives the penalty, but not ordinary income tax. In summary, the Rule of 55 can be a powerful way to access retirement savings early without the 10% penalty, provided you separate in or after the calendar year you turn 55 and keep funds in the employer's plan. However, be mindful of federal withholding defaults and the possibility of an erroneous extra 10%. Confirm coding, review your Form 1099-R, and use Form 5329 if needed. Finally, weigh the Rule of 55 against alternatives such as 72T and Governmental 457B plans to identify the most suitable approach for your situation. Thanks for watching. To continue learning, please like this video, share it with a friend who might benefit, and subscribe so you do not miss our next guide. We would love to hear your plans or questions about the Rule of 55 in the comments below. See you in the next video.